Hello friends, good evening to all of you, and first of all, happy Gurpurab to all the viewers, all the YouTube family, all the learning session family, and further may this auspicious occasion bring so much happiness and prosperity in your life. So let's start today's session, and today it is a 11th session for the BFM, that is a Bank Financial Management, and I hope that you must have enjoyed the last 10 sessions, and we got a very good response from you guys related to the newly launched CIB crash course, where we have already covered the most important things, the most important videos, case studies, chapter wise previous year questions, everything is covered over there. And if you just want to join that particular crash course, you need to write CIB crash course and WhatsApp it to this particular number. And also, if you want to join our CIB group, where we do share each and every information related to the classes and all new things related to CIB, then you should be writing CIB group and WhatsApp it to the number 83609444207, and we will be sharing the link of that particular group with you. So let's start today's session. In the last session, we have already covered related to the particular different instruments or particular different markets where the treasury is actually dealing into. And now, first of all, we are going to cover about the topic about the LF, that is a liquidity adjustment facility. Now, what is LAF? Kindly please do let me know at the earliest what is LAF over there. Now, liquidity adjustment facility is actually related to, we want to monitor the liquidity in the market over there, and for that particular purpose, Reserve Bank of India actually uses a repo as an instrument, that is a repurchase offer, and the reverse repo as an instrument, so as to do the monetary control over there. So in this particular process of the LAF, that is a liquidity adjustment facility, Reserve Bank of India actually do lend the funds to the banking sector, and that is actually done through what? That is done through the repo and the reverse repo instrument over there. Is that clear? So that is actually related to it. And further, in case there is shortage of funds, so if there is shortage of funds, in that scenario, bank or the primary dealers, they are to sell the particular instruments, or let's say the repo thing or securities, to the Reserve Bank of India. And if they'll be having the surplus liquidity, they will be buying the securities from the Reserve Bank of India for the short term basis. That is the thing related to it. So in case of LAF, that is a liquidity adjustment facility, RBI uses repo exclusively for these particular transactions, and further, this is done for the overnight lending of the funds and receiving the funds for overnight basis from the banks. So if the Reserve Bank of India wants to manage the short-term liquidity in the banking sector, in that scenario, Reserve Bank of India uses LAF as a monetary control tool right there. Okay, and whatsoever the securities which are being sold or being bought, those are kept in the SGL account. Now, what is SGL account? What is the full form of it? Kindly please do let me know in the comment section over here or in the chat box over there. I've already conveyed the same to you in the last video also. And further, if you're liking the content of these particular series, do give this video a thumbs up, and further do share this video among your friends and colleagues who are preparing for CIB 2024. And the minimum bid size for the LAF facility, it is 5 crore rupees, and the multiple of 5 crores like 10 crore, 25 crore, 50 crore as such, that's right. So that's actually all about the liquidity adjustment facility. Now after that, we are going to study about the payment and settlement system in India, and these are covered under PSS, right? That is Payment and Settlement System Act, and these are covered under the same. So first of all, we are going to learn about the RTGS, that is real time gross settlement over there. Now, real time gross settlement, what is the minimum amount of transaction under the real time gross settlement? It is 2 lakh rupees. So the minimum amount of the transaction under the RTGS, it is 2 lakh rupees minimum amount is this, and there is no upper limit. Many times people do think like there is a ceiling limit in case of RTGS, but that is a soft limit that is imposed by the banks so as for the security concerns. But as such, if we look at the system, there is no upper limit, there is no ceiling limit for the case. And this is a paperless settlement system which actually processes the data on gross basis. Let's say case the bank A wants to transact, let's say the bank A wants to transact with the bank B amounting rupees 5 lakh, and bank B wants to transact amounting rupees 6 lakh. In case of the netting of the transaction, what will happen? the net amount of rupees 1 lakh will be paid by bank B to bank A. But when we are talking about the gross settlement, in that scenario, rupees 5 lakh settlement will be upheld differently, and rupees 6 lakh settlement will be upheld differently. That is the main scenario over there. And in the infrastructure point of view of the RTGS, that is real time gross settlement system, it actually uses the Infinet that is developed by the IDRBT, and it also makes use of the SFMS. Now, Infinet is actually related to Indian Financial Network. Infinet is what? Infinet is a Indian financial network. And if we talk about the SFMS, it is a security measures which are taken care of. That is a structured financial messaging system. And IDRBT has developed the Infinet. IDRBT is particularly the one which has also developed the NFS, that is a National Financial Switch, which is particularly now particularly taken over by the NPCI, that is National Payment Corporation of India, right? So IDRBT full form is Institute for Development and Research in the Banking Technology, and further that is all about it. And the model which is being used in India for the RTGS purposes, it is the Y model. So it can also, the question from this point can also be there in the exam, that which particular model for the RTGS is used in India. So it is a Y model, Y structured model which is used in India for the RTGS purposes. And what is the minimum limit for the RTGS transactions? It is rupees 2 lakh. There is no ceiling limit. And further, RTGS operates 24 by 7, 365. There is no limit related to it. And one thing more we can say which is quite relatable to the RTGS, it's actually the NEFT. Now, what is NEFT? NEFT is National Electronic Fund Transfer. Now, what is actually NEFT? It is National Electronic Fund Transfer System, and it is actually based upon what? It is based upon the netting of the transaction. It's not like that, like I told you the example, that if the A is to transact rupees 5 lakh with B, and bank B is to transact 6 lakh with bank A over here. Now, in the RTGS, there was gross settlement of the individual transactions, but in case of NEFT, that is National Electronic Fund Transfer System, there will be netting of transactions based upon half hourly batches. That whatsoever the transactions which are basically received in half hour, those for those particular transactions, the netting will be done. Like in this case, the net amount will be that B is to pay rupees 1 lakh to bank A over there. That will be the netting of transaction. This is also operable 24 by 7, 365, but it operates on half hourly batches. 48 half hourly batches are there. And what is the minimum amount for the transaction in case of NEFT? It is rupee 1 of the minimum transaction for the NEFT, and there is no upper limit for NEFT. Kindly please take a note of it, right? So that is the case related to NEFT. After that, now we are going to study about the NDS, that is a negotiated dealing system. Now, what is negotiated dealing system? Let's have a look at it. So NDS, that is a negotiated dealing system, it's a electronic platform. It's a electronic platform. So whensoever we are to deal in the government securities, or let's say we are to deal in the money market instrument, in that scenario NDS is actually used, and it was introduced by the Reserve Bank of India in year 2002. And main purpose of actually introducing the NDS was related to RBI wanted that there must be automation in the system, there must be automation settlement, there must be automatic reporting in the system over there, and there must be some electronic platform which is available over there. And also Reserve Bank of India was of thought that the government of India securities, and further those all securities, those must be tradable, and further those must also be negotiable. So it basically performs on two bases. We can do the trading of these securities, and as well as a court driven mechanism is also there in case of the NDS, that is a negotiated dealing system. And further, the membership of NDS is actually open to everyone, like it is open to the banks, it is open to the primary dealers, it is open to the mutual funds and financial institutions and insurance companies, for those all particular categories who are maintaining a SGL account, that is a subsidiary general ledger account, with Reserve Bank of India, or maybe it may be the constituent of these particular banks out there who are through the bank. Let's say I am maintaining, let's say a particular primary dealer is there who is maintaining a SGL account through the bank with the Reserve Bank of India. Those can also be participating using the NDS system, that is a negotiated dealing system over there, right? So that is related to the NDS, and further we have already learned the basics related to it. Now let's learn about the CRR and the SLR, because it's quite important to learn about these concepts also, right? So let's pay attention toward the same. Now we are going to learn about the SLR and further CRR, right? So we will be learning about the same. Now the basic difference between the SLR and CRR is actually related to, I can say, it's about which act or which sections are defining the same. So CRR is defined under Reserve Bank of India Act, whereas SLR is defined under the Banking Regulation Act, right? So these are the different acts where those have been defined, and the SLR is defined under section 24. It is defined under section 24 of the Banking Regulation Act, whereas in the case of the CRR is defined under section 42 subsection 1 of the Reserve Bank of India. That's the main case. Now let me just tell you one thing related to it, that Reserve Bank of India is having the sole authority so as to issue the currency notes. So when the currency notes are to be issued, the Bank of India is having the sole authority related to it as per the section 22 of the Reserve Bank of India Act over there. And whatsoever the particular currency notes which are deposited in the banking sector, there is a multiplier effect to the same. Now what is the multiplier effect? Let me just explain it to you. Let's take the case that 100 crore rupees of currency notes have been issued by Reserve Bank of India. This is a currency which has been issued by the Reserve Bank of India. Now let's say people are depositing the money with the bank there, and further let's say the bank is to maintain some of the risk weight assets and the for the provisions over there, and bank will be lending these funds. Bank will be lending these funds, or bank will making the investments in the different avenues so as to make the profits out of there, because the banks are also to pay the interest rate to the depositors. That's the main case. Now once the bank has lent the money to the public over there, now public in turn will be, again, let's say we are considering the public to whom the loans have been sanctioned, right? Now that public is once again will be depositing with the money, depositing the money with the bank again. They will be again be depositing the money here, there, anywhere, and the money will come back to the banking channel again. Now against the 100 crore, it may be after some time in the case that the loans which have been sanctioned, they must have surpassed even 100 crore rupees. So even if you are having rupees 10 in your hand, it may be the case that you have lent rupees 15 to the public. So that may be the scenario, and this is said to be what? This is said to be the multiplier effect, because other than also the cash dealings, the bank is sanctioning the letter of credits, the bank is having the off balance sheet exposures, the bank is having the contingent liabilities. So if we take all the things in account, it basically give rises to excess of the credit, which is quite multiple of the actual deposits that the banking system were having, right? So that's the multiplier effect, right? So you must be having learning the definition, and further you must be having the awareness related to what is multiplier effect, right? That's a basic related to the multiplier effect. I hope that this is one is clear to you, right? Now after that, it's actually related to the monetary policy of the Reserve Bank of India. Now, which is part of the money is said to be the broad money. M3 is said to be the broad money. M3 is said to be the broad money, right? There is two type of money. One it is a narrow money, other one it is a broad money. I'm not going to discuss the details out there, but this is said to be the broad money, right? And further, now let's consider the monetary policy of the Reserve Bank of India. It's actually about the monetary policy of the Reserve Bank of India. Now, the Reserve Bank of India is having the responsibility and also has given me the authority so as to manage the inflation, so as to manage the external rupee value over there, and so as to ensure the stability of the financial markets out there. And for that particular purpose, the Reserve Bank of India must be having the complete control over the broad money. So RBI must be having the complete control over the broad money that is actually required in this scenario, and this is denoted by M3. This is denoted by M3. Now there is a mean by which the particular Reserve Bank of India has impounded through the RBI Act, and further through the Banking Regulation Act. Reserve Bank of India has impounded that the banks are to maintain the cash reserve ratio and the statutory liquidity ratio, so that there must be some resiliency in the banks so as not to give all the particular deposit as the loan, because the loan banks will be sanctioning the loan because they want to earn the money out of it. So it's kind of imposition on the banks. It's mandatory for the banks so as to maintain the statutory liquidity ratio and so as to maintain the cash reserve ratio. So the banks who are scheduled commercial banks, it's mandatory for them so as to maintain the CRR under the section 42 of the Reserve Bank of India Act. And the banks who are even the non-scheduled commercial banks, they are to maintain the CRR as per the section 18 of the Banking Regulation Act out there. Is that clear? Now, let's learn in detail about what is CRR. Let's learn in detail about CRR. Now, CRR is particularly the cash reserve ratio. Now, whatsoever the NDTL, whatsoever the NDTL is with the bank, NDTL is net demand time liabilities, right? Whatsoever the NDTL, the bank is having a fixed percentage is to be maintained. A fixed percentage is to be maintained on fortnightly average ratio basis. On fortnightly average ratio basis, the banks are to maintain a fixed percentage of the NDTL with the Reserve Bank of India in the form of cash balances. In the form of cash balances, this is actually to be done, right? This is actually to be done. As I've told you again, this is defined under section 42 subsection 1 of the Reserve Bank of India Act, and on daily basis 90% of the NDTL minimum is to be maintained. 90% of the average is to be maintained, and on fortnightly basis the complete percentage basis of the same is to be maintained with the Reserve Bank of India, right? And whatsoever the balances which are kept with the Reserve Bank of India for the CRR purposes, there will be no interest rate which will be paid by the Reserve Bank of India. Previously, it was the case that the interest was paid by the Reserve Bank of India on the balances, but now no interest is paid by the banks on the balances which are kept as a CRR, right? So let me just simply write over here that no interest is paid. Is that particular thing clear over there? Now, if we talk about the NDTL in detail now, if we just talk about the NDTL, which is net demand and time liabilities. Now, first of all, consider about the demand liabilities over there. Demand is basically whatsoever the balances are there in case of CASA, that is current account, saving account balances, whatsoever the balances are available, that is covered as a demand liability. The FDRs which are overdue, those are also the demand liability, because the bank is to pay immediately the amount whensoever the person will be saying to pay that, right? That is the case. And also whatsoever the credit balance in CC limit, credit balance in CC limit, that is also a that is also a demand liability. That is also a demand liability over there. And if we talk about the time liabilities, if we talk about the time liability, in that particular scenario we consider the amounts which is there as FDR, or particularly as a recurring deposit over there, or we can say cash certificate over there, or margin on the letter of credit over there, right, which is particularly there for the longer duration of the term, right? That is also that is covered as a time liability. That is covered as the time liability. And also there is one term which is other demand and time liabilities. We also cover one term over here, which is other demand and time liabilities, right? That is also covered. Now, in this scenario, when we are talking about the other demand and time liabilities, the bills payable, the bills payable, if there is any dividend unpaid, if there is any dividend unpaid, that will also be covered. If there is any sundry account balance, that will also be covered. Participation certificate, that will also be covered. Those all are covered as the different elements. I'm just letting you know about the elements, that what is about the demand liabilities, what is about the, I'm just giving you the idea about the same, what is about the demand liabilities, what is about the time liabilities, and what is about the other demand and time liabilities out there. Now let's say bank ABC is there and it says I don't want to basically maintain the CRR. I just don't want to maintain. Now in that particular scenario, what will happen? A penalty is imposed by the Reserve Bank of India. I just told you that the CRR is to be maintained on fortnightly basis. It is to be maintained on fortnightly basis, but a daily average of minimum 90% of the fortnightly basis is to be maintained, right? That is particularly to be maintained. And which liabilities? This question can be asked in the exam. This question can be asked in the exam, that which liabilities are exempted, which liabilities are exempted and are not covered under the NDTL. When we are basically computing the NDTL, which liabilities are exempted? So whatsoever the paid up capital is there, that is to be exempted. Whatsoever the paid up capital is there, that is to be exempted. Whatsoever the reserves are there, those are to be exempted. The reserves are to be exempted. And whatsoever the balance there in profit and loss account, profit loss account, that is to be exempted over there. And even if the banks have borrowed the money, or simply we can say the amount borrowed from Reserve Bank of India, let's say the amount is borrowed from RBI, Reserve Bank of India, or maybe from the IDBI, Industrial Development Bank of India, or maybe from the Exim Bank of India, or maybe from the NABARD out there. So what are the institution, government financial structure institutions are there, and further, if the amount is borrowed from the same, that is also to be excluded. That is also to be excluded. And further, let's say if you have basically invoked the guarantee from DICGC and ECGC, right? So though that is also not to be considered. If you have invoked the guarantee and you have received the sum of money, and you have received the sum of money from ECGC, or from DICGC, right? That is also to be exempted. So these are the things which are to be exempted, which are to be exempted. And other than that, if there is any net particular interbank borrowing, if there is net interbank borrowing which is not exceeding 14 days, in the money market there may be the case that there is interbank borrowing but it is not exceeding 14 days, that is also to be excluded. That is also to be excluded. And further, if there is any balances which are, let's say, credit balances with ACU, Asian Clearing Union countries, if there is any credit balance with ACU, that is also to be exempted. Is that clear? So these are the clear purposes. These are the clear purposes, right? Which are exempted. And previously, whatsoever the transaction amounts related to CBL were there, that is collateralized borrowing lending obligations were there, those were also exempted. But now those are not exempted. Now those are not exempted. Previously those were exempted, but now those balances are not exempted. And as I told you, if some bank says, let's say we are not to maintain the CRR, we won't be maintaining CRR, then in that particular scenario, penalty is imposed. Let's say case, particularly if bank says I won't be maintaining the CRR, we are not going to maintain the cash reserve ratio, right? And further, it may also be the case there is shortfall. There is shortfall. The bank was to maintain, let's say, 100 crore as per the CRR, but the bank maintained 90 crore or 95 crore, and further it is said to be shortfall of security. It's a shortfall of the CRR. So either they are not maintaining the CRR or there is shortfall of the CRR. They are to pay the penalty. They are to pay the penalty interest to the Reserve Bank of India, right? So for the first timers, the penalty will be 3% per annum basis. 3% per annum basis above the bank rate. Now, whatsoever the bank rate is there, whatsoever the bank rate is there, plus 3%, that will be particularly paid as penalty. That will be paid as penalty to Reserve Bank of India. But if it is repeated, if it is continuing contravention, we can simply be saying, if it is continuing contravention, that for the another fortnight you were not able to maintain it, because it is to be maintained clearly on fortnightly basis. Clearly on fortnightly basis, I just told you, if you basically were not able to maintain the average for the first fortnight, the penalty will be 3%. But if you are not able to maintain, and for the if there is shortfall continuing for the another fortnight, in that scenario, the penalty will be 5% per annum above the bank rate. Above the bank rate, that penalty will be charged to the banks. That's the case. And still, if the shortfall persists even after that, if the shortfall persists even after the second fortnight, then every director, every secretary who's actually willful to this particular default, they are punishable with the fine. Those can also be punished. Those can also be managed. Now, there is actually a report which is to be submitted by the banks. There is actually a report format which is to be submitted by the banks to the Reserve Bank of India, and that is actually covered under section 42 subsection 2 of the Reserve Bank of India. It's actually give the format related to the reporting to the Reserve Bank of India, right? Now, every scheduled bank, because CRR primarily, which is covered under the RBI section 42, RBI Act section 42, they are to maintain the CRR, that is a cash reserve ratio. So every scheduled commercial bank, we are talking about the scheduled commercial banks over there, they are to send a report. They are to submit a report to the Reserve Bank of India. To whom the report is to be submit? To the Reserve Bank of India. And the report must be showcasing what? It will be showcasing the position of demand and time liabilities. Now, whatsoever the position of the demand and time liabilities, and further whatsoever the position of their borrowings over here in India, and that must be classified in demand and time liabilities as at the close of the each alternate Friday, right? Demand and time liability position as at close of each alternate Friday. The position is to be submitted to the Reserve Bank of India. And further, so whatsoever the period this particular information will be related to, within 7 days, within 7 days, the report is to be submitted. This report is to be submitted to the Reserve Bank of India within 7 days. Let's say it is related to a 14-day period, and further from the end of that particular period, within 7 days, the report is to be submitted to the Reserve Bank of India. That is the scenario. Is that clear? Okay, I hope that you are clear with the CRR point of view. Now, after that, we are going to learn about the SLR. We are going to learn about the SLR. That is what? That is a statutory liquidity ratio. SLR is statutory liquidity ratio, and this is covered under which section? This is covered under section 24 of the Banking Regulation Act. This is covered under section 42 or section 24 of the Banking Regulation Act. And same again, the same thing, that every bank must be maintaining a fixed percentage of net demand time liabilities, in the form of either cash, or in the form of gold, or in the form of approved government securities which are not encumbered. Approved government securities which are not encumbered, like which on which no charge has been created so far. In that particular form, a fixed percentage of NDTL is to be maintained not with the Reserve Bank of India but within India. That is to be maintained within India over here. So that is the main clause. It's not the case as of the CRR. CRR balances were to be maintained with the Reserve Bank of India. But now in case of SLR, this particular securities in the form of cash or in the form of gold or approved government securities which are not encumbered within India, the particular percentage of the NDTL is to be maintained. It is to be maintained. And this is said to be what? This is said to be the statutory liquidity ratio. And the upper limit of the SLR is what? What is the upper limit of SLR? Anyone? Kindly do answer. If you have already gone through this particular topic, kindly do let me know that what is the upper limit for the statutory liquidity ratio. The current ratio, the current SLR, which is to be maintained is 18%. I've already told you when we basically discussed about the FVLL, CR and MSF over there. I have already explained the idea to you when we were covering the module B, right? But do let me know what is the upper ceiling for the SLR. What is the upper ceiling limit for the statutory liquidity ratio? So the upper limit is what? It is 40%. Upper cap, we can say, upper limit, we can say it is 40% in case of SLR. That is a statutory liquidity ratio. It is 40%, right? So mainly, if I'm saying it is 18%, what does it indicate? It indicates for every net demand time liability, or let's say for every deposit the bank is having, let's say the bank is having 100 rupees of the deposit, rupees 18 is to be maintained in the form of the cash or gold in the form of the approved government securities. That is the scenario. That is the scenario. And Reserve Bank of India is basically responsible for the particular course over here that is to be maintained, and it can be in the form of cash in hand. It can be in the form of the government, in the form of the government particular approved securities, or it can be in form of the gold which is owned by the bank, right? And further, if there was excess of CRR which was maintained previously, let's say the CRR requirement for the bank was 80 crore and the bank was maintaining 100 crore of the cash with the Reserve Bank of India. Now the excess of the 20 crore was there. That can be also be considered as a component of the SLR. That can be considered as a component of the SLR over there, right? So these are the component which can be there, right? And further, SLR is to be maintained on daily basis. Unlikely we were to maintain the CRR on fortnightly basis. SLR is maintained on daily basis. And what will be the reference point of the NDTL? It is maintained on daily basis. But what will be the reference point for the NDTL? That is the net demand time liabilities. It will be based on the NDTL. It will be based on the NDTL of the last Friday. Based on NDTL of last Friday of second preceding fortnight. That is 28 days from now. 28 days before, right? Second preceding fortnight. Is that clear? So that will be the reference basis for the NDTL there. And what is the penalty? If the bank is not maintaining SLR or there is shortage, first of all, there will be 3% of penalty. Now let's talk about the penalty. Now, if there is particularly not being maintained or shortfall, then the penalty will be 3% per annum above the bank rate. Now, whatsoever the penalty which is charged in case of the CRR and SLR, that is 3% above the bank rate. And if there is continuing contravention, that for the first day, if the SLR was not maintained, it will be 3% per annum basis. And for the second day, even if it is not maintained, then it will be 5% above the bank rate. It will be 5% above the bank rate. The penalty will be charged, right? So that is the case. And what is the return which is to be, there is a report, there is a return which is to be submitted. We cannot be saying it a report. It is a return which is to be submitted by the bank to the Reserve Bank of India. There is a return for that, right? And further, the return will be in the form of Form 8. The return which is filed by the bank with the Reserve Bank of India, it is Form 8. And further, the report is to be submitted to whom? The report is to be submitted to the Reserve Bank of India. It is to be submitted to the Reserve Bank of India before the 20th of every month. Before 20th of every month, the report is to be submitted by the bank to the Reserve Bank of India, and it will be showcasing the amount of SLR that was being held on alternate Fridays in the preceding months, and also the position of the demand time liabilities on alternate Fridays in the preceding month over there, right? So let's say if we are talking about the month of May, so report is to be submitted latest by 20th of the June, but a report will be showcasing the data related to the SLR balances which were being maintained on alternate Fridays, and also the position of the DTLs on alternate Fridays, right? So that's the case related to it. So that will be the case related to the same. Is that clear? Now, that is actually all related to the particular chapter, that is the chapter number 3 over here. And now we'll be considering and we'll be going for the very important chapter, that is a chapter number related to the derivative products. So we'll be covering the topic related to the derivative products over here. We will be covering the treasury risk management chapter later on, but beforehand we are going to cover the derivative products and how come the derivative products are important, right? So let's consider that particular chapter. So I have prepared some notes for you guys. These notes definitely will be helping you a lot. And if you want me to share the particular notes, I can be sharing the same in the WhatsApp group. So as to join the WhatsApp group, you need to write CIB group and need to WhatsApp it to the number 83609 right? So now we are going to talk about the derivatives, that what it is derivative. What is a derivative? Now, as the name suggests, derivative is not having the value of their own, right? Derivative is not having any value of their own, and their value is actually derived from the underlying asset. So whatsoever the underlying asset will be there, it can be a commodity, it can be a security, it can be a equity, or it can be further anything, right? So which is particularly having some value, right? So it can be based upon that particular asset over there, and it will be having some value. Now, what is the main purpose of issuing the derivative? What is the main purpose to issue the derivative? First of all, using the derivative, we try to hedge ourselves. Using the derivative, we try to hedge ourselves, means we try to safeguard our risks over there. That is the main thing over there, that we want to manage our risk. We want to manage our risk. Let's say case I'm having a position where I think I may be having some loss. I want to safeguard myself. I can be using the derivative. And also in the case of the credit risk, in the previous module, we have already read that we can use the credit risk mitigants, that the credit derivative can be used over there. Like we read about the CDS, that is a credit default swap. We talked about the TRS, total return swap, and all the other things over there. And CLN also, that is a credit linked note over there. Those all were what? Those all were the derivatives, right? That's the first thing which it can be used for. The second thing where the treasury can be using the derivative, let's say the corporate customer wants to enter into some transaction. They basically, we want to cater the we want to basically cater the corporate customers. Now for that particular purpose also we can be entering into the derivative transaction. Let's say case the corporate, let's say, wants to purchase a forward contract. They want to purchase a forward contract, like they want to, let's say, purchase 1 lakh USD after 1 month period. After 1 month period. Now it will be a forward contract. It will be a forward contract which will be entered into by the bank over there. And when we're talking about the forward contract, it's what? It is a derivative. It is a derivative because it is not having a value of their own. It's basically based upon the spot rate over there, right? Spot rate plus premium or discount, right? So that's whatsoever the case it is, right? So it is a derivative over there. So that is the second way. So that is the second way that why derivative is used. The third one, it's related to, it can be used for the trading and speculation purposes. Like, you must be aware that the people do purchase the option a lot in the market now. The people do purchase futures there in the market now. So particularly we can say the derivatives can also be used for the trading and speculation purposes. They can be used for the trading and the particular speculation purposes right there. Is that clear? Is that particular point clear over here? Now, there can be two types of derivatives. There can be two types of derivatives, like the way they can be the exchange traded derivatives, and also there can be the OTC, it is over the counter derivatives. First of all, if we talk about the OTC, let's say case bank A is here, bank B is here, and bank A is dealing individually with the bank B over there, or let's say A is a bank and B is a customer. A is the bank and B is the customer, and they both are dealing with each other. Now in this particular scenario, they are dealing with each other, so they can be creating a contract based upon the each other needs over there. They can be a tailored contract over there, and further they too will be dealing with each other. So that is what, that is a OTC, that is a over the counter contract. It is an OTC, that is a over the counter contract. And what do you mean by exchange traded contract? Where there will be a standard agreement, and further it is traded using a stock exchange or any reputed exchange over there, like we are dealing with the futures. Now futures are basically traded on the exchange. Now that is what, that is exchange traded derivative, right? So there can be two types of derivative. One, it is related to the exchange traded product, derivative product. The other hand, it can be the over the counter derivative product. So there can be two things related to it, right? Now first of all, it's related to the over the counter derivative. It's related to over the counter derivative. We are going to compare the two, right? So over the counter derivatives, these are offered by the banks and the financial institutions. These are not basically available anywhere. These are not offered by anyone else. These are offered by the banks and the financial institutions. And as I told you, two parties are basically dealing with each other. Now it can be a tailored contract where you can be having a customized contract date, customized maturity, customized amount over there. So customizations can be there in case of the over the counter contract, right? And further, whatsoever the price of this particular over the counter product will be, it will be quoted by the bank itself. Now the bank will be keeping the margin of their own, and further they'll be quoting the price. Let's say case the particular forward price, the forward rate of 1 USD after 2 month period, it came out to be 86 rupees, but bank kept the margin of 0.40 paisa for $1 and further quoted the price to be 86.40. That is particularly what, that is a OTC price that was conveyed to the customer, right? And even if the customer, even if the particular, let's say bank want to maintain some cash margin or some other security, or the charge on the securities to be created, that is to be done as per the bank's own discretion. That is to be done as per the bank on discretion. Because let me just tell you a very clear funda related to OTC, that there is no written guideline for the same. There is no standardization in case of the OTC, that is over the counter product over there, right? But as the case is that the two parties are individually dealing with each other, it may be the case that the one party is not able to fulfill the obligation. So there always exists a risk, that is a default risk, that is actually said to be the counterparty risk, is heavily present in case of the particular over the counter contract. Is that clear? So counterparty risk is present. That's a fifth point over here, that the counterparty risk is present in this scenario, right? And whensoever the delivery is to be done, the delivery is mostly the physical delivery. Physical delivery means what? That the actual amount of the transaction is to be paid. There is no net amount, there is no net settlement will be there. There will be an actual amount which is will be paid. Let's say person A bought 10,000 USD from person B. In that scenario, person A will be paying 10,000 equivalent rupees to the person B over there, and person B is to pay 10,000 USD to person A over there. So there is physical settlement of the same, right? And this is mostly used for the hedging purposes, that whensoever we want to safeguard ourselves, for that particular purpose the derivative is used, that the OTC's derivative is used, right? So that's related to over the counter derivative. That's related to over the counter derivative. And if we talk about the exchange traded derivative, in that scenario, if we talk about the exchange traded derivative, now exchange traded derivative is actually traded on some recognized stock exchange. On some recognized exchange, these are being traded. These are having the standard size of the contract, standard maturity date, standard everything. So everything is standardized in case of the exchange traded derivatives. There is everything which is standardized, and further there is particular pricing is transparent. There is particular note that the bank will be pricing as per their own discretion, as per anything. So there is screen based trading, or there is transparent pricing in case of the exchange traded derivative. And further, the daily cash margin is actually collected on the MTM price basis. Now what is MTM? MTM is actually related to marked to market. It is marked to market basis. Let's say the yesterday price was rupees 100. Let's say yesterday price was rupees 100, that is it, and today the price became 96 rupees over here. Today the price became 96. So by the day end, if the price was 96, then rupee 4 will be deducted from your settlement account, and further the net balance in your account will be 96. Let's say next day after that the amount become 105. Now in that scenario, rupee 9 will be basically credited to your account. So that is the net settlement or daily settlement on MT, that is mark to market basis, that whatsoever the day end price will be there, based upon that the amount will be credited or debited. So that is a daily cash margin which is being maintained. And moreover, now if the person is the buyer and person B is the seller, they are not dealing directly. There is the exchange in between through which they will be dealing with each other, through which they are going to dealing with each other. So there is no counterparty risk which is present in case of exchange traded derivative. And settlement mostly in this scenario is particularly related to net settlement, is related to the net settlement, because everyone in the market is not there so as to buy the product, and for the 99% of the parties are there for the speculation purposes. Let's say case there is a commodity which is on the exchange and person A is representing the buyer. So person A community is representing the buyer community and person B community is representing the seller community, and for the person C is actually related to what? The person C over here is actually related to the trading community or particularly speculative community. And further the product is actually listed on the stock exchange. This is actually listed on the exchange over here. And further A will be bidding to buy. Let's say it said we will be purchasing for 100, and further B is ready to sell for rupees 105 over there. And further the speculator C said that the prices will go up, and they said that we are ready to pay 115. The prices will go up. The prices will go up because the demand is high, and ultimately on the settlement day whatsoever the price is, the buyers would be buying at that particular price. The buyers will be ultimately the buying that particular price for the that particular price. But in this scenario the physical settlement is mostly not there. Until or unless it's not a commodity, the physical settlement is not there. The net settlement will be there. Let's case A were bidding for, that is buyer were bidding for 115, and further the seller were bidding for 120. Now in this scenario when the day closed, let's say amount was 120, so the net amount which is to be paid by the buyer to seller is rupees 5 only. The net settlement will be done only. That is the case. Is that clear? Is this particular point clear over here? And basically, if we talk about the derivative, the basic type of the derivatives are four types. We are having three types, sorry. We are having the forward contracts. We are having the forward contracts. We are having the options with us. And also we are having the swaps. So the first category, it's actually related to forward contract. The second one, it's related to options. And the third one, it's actually related to swaps over here. Is that clear? Is this particular point clear over here? Kindly please do let me know. Now, in case of forward contract, if we talk about the forward contract, in that scenario, it's a OTC contract, that is a over the counter contract. Person A wants to buy USD from person B. So it is what? It is a OTC contract because A want to buy, let's say after 2 months, but it wants to make sure the price won't change, right? So particularly it's a forward trade is a particular OTC contract so as to deliver the foreign currency on some future date with a fixed exchange rate. And further the bank will always a counterparty in this scenario. Bank, I mean authorized dealer, will always be a counterparty in this scenario. That's actually I can say highlight about the particular forward contract, right? The second one, it's related to options. Options actually do provide us with a right but not an obligation so as to buy and sell the product. So it can be a call option, it can be a put option. We'll be learning in detail about the options over here, very important topic. And the further third one, it's related to swap. Now swap is actually related to exchange the cash flow. It could be related to IRS, that is interest rate swap. It could be related to FRA, that is forward rate agreement. It could be also related to the currency swaps over here. So we will be learning about these all three types of swaps in detail. Is that clear? Now, first of all, let's learn about the forward contract. As I told you, forward contract is what? Forward contract is a OTC contract, that is over the counter contract, where there are only two counterparties, and one counterparty out of this will be a bank. One counterparty will be a bank which will be dealing with each other. Let's say the case. Let's just take a simple example over here. That person A said that I want to buy 10,000 USD, 10,000 USD, and bank over here quoted the price. Bank over here quoted the price. Which price shall be quoted by the bank over here? Which price shall be quoted by the bank over here? Kindly do let me know at the earliest. I have already explained the OTC, that is a over the counter contract, and I'm just in the process. I'll be explaining to you again, right? So OT is over the counter product where their two counterparties are dealing with each other. And further now, only two parties when they are dealing with each other, there definitely can be a tailored product, right? So there is no standardization in this particular scenario. Whatsoever the cost is to be charged, that will be as per the discretion of the bank. Whatsoever the security is to be taken, that is on the discretion of the bank or the particular counterparty over there. And also now two parties are dealing with each other, definitely the counterparty risk is there, which is not present in case of the exchange traded derivative, right? So that's the case. So now when the A wants to buy the 10,000 USD, let's say it wants to buy the 10,000 USD after 2 months. Now in that scenario, the price which will be quoted by the bank, it will be the selling price. It will be the selling quote at which the bank is ready to sell. So it will be a selling quote which will be given by the bank over here, which will be given by the bank over here. So that will be the scenario over here. Is that clear? Now this particular rate will be given. Let's say case price quoted for 2 months, selling quote is 84.76. This was the price which was given. But now let's consider the case that after the 2 month period, the price of USD was, after the 2 month period, let's say the price of USD was 83.90. Now, at which price person A will be having the right or obligations as to go for? If the person A is to buy only 10,000 USD, now at what price the person A will be buying the USDs? Kindly do let me know at the earliest. You can also be commenting the same in the comment section below. And if you want to get the PDF for the same, you can be getting simply on our WhatsApp group. You need to WhatsApp CRB group to the number 83609444207. So what will be the price which will be at which the transaction to be concluded? Very right. So Savraj Mohanty has given a right answer. It is 84.6 only, at which the price will be counted for. Why so? Why 84.76? Because it's a forward contract. It's an obligation now. It will be a obligation on the person A. He is to buy on this particular price only, 84.76. The market price won't be mattering to person A. The market price, although the market price is favorable, right, but it cannot be done. Even if the person A cancels the contract, even the person A cancels the contract, the person A is to pay the swap cost for the same. It will be a fine, or we can say a penalty on person A so as to pay the swap cost for the same. Is that clear? Kindly do let me know at the earliest. Now we are basically having an example over there. Person A wants to buy 10,000 USDs after 2 months. That's the example I just quoted to you. And the bank quoted the forward rate to be 85.40 INR over here. Now, holder of the contract can get the benefit of the market prices. No, the person cannot be getting the benefits of the market prices. That is not allowed in this scenario. That won't be allowed in this scenario because it's a forward contract. And this is actually ideal for what purposes? It is actually ideal for the hedging purposes. It is actually best for the hedging purposes here. Is that clear? Now let me just give you an idea related to basics of the options, or we should be solving a question based upon the forwards. Kindly do, please do let me know at the earliest. We have already solved the question based upon the same, so we won't be kindly you can be giving me an idea that we are having the just 2 to 3 minutes with us. Let's just simply solve the question based upon it, right? So let's just consider the case that we are having. Let me just draw a column over here, right? So let's say we were having 1 USD is equal to 76.10 slash 30 as the price. That is the spot rate which is given over here. And 2 month forward points are given to be 36 slash 46, right? And further, we have to calculate the 1 month, we have to calculate the 2 month forward. Let's say we have to calculate the 2 month forward buying rate. 2 month forward buying rate is to be calculated. Now, what way we can be calculating? What way we can be calculating the same? Anyone kindly do post the answer. Anyone kindly do post the answer over here. We have to calculate the 2 month buying rate. See, now no reference to the customer is given, so it will be the interbank market rate which will be applicable. No reference to the customer will be given, is given over here, so it will be interbank market rate which will be applicable. It means buying rate will be the buying rate and selling rate would be the selling rate. Otherwise, if the customer reference is given, in that scenario, buying rate will be the selling rate and selling rate would be the buying rate, right? So that is the difference. Okay, so now we'll be considering the 2 month buying rate. So it will be what? It will be the buying rate only. So we have to consider the buying rate. So here 76.10 is the buying rate, 76.30 is the selling rate. So if we talk about the spot rate here, spot rate will be equal to what? 76.10. That is a spot rate buying. Spot rate buying is 76.10. And also the currency would be available at premium and discount. Let us check the forward points after 2 months. If we do check the forward points after 2 months, these are 36 slash 46. Now the selling forward points are here and the buying forward points are here. And there is a simple rule. If the selling forward points are higher than that of the buying forward points, then the currency is available at premium. We say the currency is available at premium. And if selling forward points are lesser than the buying forward points, we say the currency is available at discount. And if the currency is available at premium, we are to add the data. We are to plus the data. And further, if the currency is available at discount, we are to subtract the data. Is that clear? Is this point clear to you? Okay, so we'll be going for the same. So over here the currency is available at premium because the selling forward points is greater than the buying forward points, so the currency is available at premium over here. Now if the currency is available at premium, we'll be adding the buying forward points, that is 0.36 is to be added. 0.36 is to be added, so it will be 76.46 over here, which will be the answer. Okay, is this point clear to you? So that will be the answer. So Madhu Mohan and Svraj Mohante both have answered correctly for this question. And I hope that you must have understood the concept over here. And in the next video, we are going to cover the options. We are going to cover the types of options. We are going to cover the FRA, interest rate, swaps over there, and everything that is actually mentioned in the particular file we will be covering tomorrow. And other than that, we'll be covering the questions based upon that too. Now, right after this particular session, we are having the class related to the ABM, which is again very much important. We are going to cover the theory of probability and everything, which is particularly listed over here. We are going to cover everything over there. So I have actually done my homework. Now I want to join the session so that you can be learning this particular concept right after this particular session. So do join the ABM class right now. And further, if you have liked our video and further if you feel like it was worth watching, kindly do give this video a thumbs up. Kindly do like this video and further do share this video among your friends and colleagues who are preparing for the CRB. So that will be all related to this video. Thank you so much and see you again in the next video tomorrow. And yes, there is an important information. There is going to be no class tomorrow, and Sunday we'll be having a session in the morning, right? I'll be sharing the timings very soon in the WhatsApp group.